Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 7th of December. I'm Daniel Lam, your host for the podcast. 2 evenings ago, I played terribly in the chess tournament. I was surely losing in one of the games until my opponent blundered a full queen to me. I then remembered one of the many infamous lines by Gordon Gekko, played by Michael Douglas in the movie Wall Street, which was, quote unquote, "I bet on sure things." Well, those of you who've been following the FIFA World Cup in Qatar would know that there are no sure things in life. Well, except for death and taxes, perhaps, which is yet another line from the movie Wall Street. Since October, the eye popper in the financial markets should be the Hong Kong China equities. Many market commentators have turned very bullish on Chinese equities, especially over the last couple of weeks. Is this turning into a sure thing? Well, we've flagged a number of times that the medium-term narrative in China has been improving, i.e. potential further reopening in the economy, the backstop in the property sector, as well as potential for more constructive discussions between the US and China. But with the Hang Seng Index already up by more than 30% in less than 6 weeks, how much of this is already in the price, at least for now? So if you dig deeper into the Hang Seng Index, you will notice that it broke above the critical level at 18,500 and completed a reversed head and shoulders bullish pattern at the end of November. But at the same time, momentum indicators are looking very overstretched. Let's look at the RSI, the Relative Strength Index. Now, most people say that above 70 is overbought, but it's actually not so simple. The more reliable way of looking at this is to check whether the RSI has been making new highs. Now, in this case, it hasn't, but the index had. So what does that mean in layman's terms? So it's like a car going up a steeper and steeper mountain, but its horsepower is not increasing. That means the index is prone to short-term pullback. Investors should therefore consider buying Hong Kong China equities on this pullback because, like we said before, the medium-term narrative is still constructive. And the index did start its rebound from a very low base. A good level to look at on the Hang Seng Index would be the 18,500 level aforementioned, followed by 17,600. So investors may consider going in steps. If you want to pick sectors, in our opinion, consumer discretionary and communication services are worth highlighting. These 2 sectors are dominated by bellwether internet consumption plays, which are benefiting from the fading regulatory saga. Earnings in November have been revising upwards due to the beats. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.